this is sort of where real estate becomes more of an art than a science because there's not always a very specific way to do this. What I recommend to people is to really think about your long-term strategy because flipping a house and being a rental property investor, they're pretty different businesses. They both fall under the category of being a real estate investor. But if you think about what the skill sets needed to be successful at one, it's kind of different, especially if you think about the time investment required to be good at one versus the other is pretty different.
Welcome to Wealthy On. I'm your host, Andrew Brill. How would you like to sit back, relax, and let your money work for you while you do something you really enjoy? We'll explore one way to get that done right now. I'd like to welcome Dave Meyer to Wealthy On. Dave is the head of real estate investing at BiggerPockets. He's the host of the BiggerPockets podcast. He's also an author. Dave, welcome to Wealthy On.
Thank you so much for having me. I'm excited to be here.
Absolutely. So congratulations on your 1,000th podcast. I know that milestone just passed. So that's a big one. We'll get there one day.
Thank you very much. I haven't been the host for the whole time, so a big shout out to all the other people who have made the 1,000 episodes possible.
So tell us about BiggerPockets and what you guys do and how it all works.
BiggerPockets is a platform to help ordinary Americans gain the many financial benefits of investing in real estate. And we do that through a lot of media channels. So we have podcasts, books, YouTube channels, and we also have software that helps people analyze deals, find markets, connect with agents, that sort of thing. But we believe that real estate is an excellent way to build long-term wealth, but it can be tricky for people who don't know how to do it. And so we help them do it.
So it's kind of a teaching platform, but you also connect people who want to get into this sort of thing.
That's right. So we have all the education you need, but real estate, I think surprisingly to many people, is really a relationship business. You really need to have a great team around you. And so we also help people do that in addition to just helping them understand the fundamentals.
So how did you get into real estate investing?
It's a funny story. I graduated college in 2009. I moved out to Denver from New York, and 2009 wasn't a great job market. I was waiting tables and had a couple free days a week, and I'd just go skiing and did it with a friend of mine. And just to be honest, wasn't my smartest friend, but he got into real estate investing and was killing it and was doing, buying rental properties, making all this money. And I thought, if this guy can do it, I think I can too. And luckily I was correct. I wound up partnering with a couple people. I didn't have a lot of money at the time, but I was able to partner with a few people to buy a rental property. I self-managed it, figured out how to be a landlord. And that was almost 15 years ago. And I've been doing it ever since.
So it seems that it's becoming more and more popular, the real estate investing piece of it. I know you started quite some time ago, but have you seen an uptick in people buying rental properties or buying properties to flip them and stuff like that?
On our platform, absolutely. When I started at the company, we were maybe 300,000 members. Now we have over 3 million. So I think that speaks to the growth of the industry in general. And I think there's a good reason for it. First and foremost, real estate is a great way. It is, in my opinion, the best way to replace your income with an investment. The stock market's great. There are tons of other asset classes, but real estate has an ability to pay you regular cash flow, which I think is really important to people because it can help them move up their retirement date. I also think millennial generation, Gen Z, we hear this common refrain that people want to have multiple streams of income. They want to diversify how they earn money. I don't know if that's from distrust of corporate jobs or what, there's just a trend, but it's a great way to sort of add secondary income as well. And the third thing is, it's not that complicated. I know it's intimidating and that is true, but when you learn about real estate investing, it's pretty simple. It's like one of the oldest businesses there is, right? You're collecting rent, you're trying to control expenses. And if you can learn the basics of that, most people can become successful investors.
Can this replace a job? You can actually make a living at doing this sort of thing, right?
Absolutely. And that has become a popular refrain. I think at BiggerPockets, what we try to stress is that that is not always the objective, and it's not necessarily the easiest thing to do. If you start with a ton of capital, you could probably replace your income in a couple of years, 3 to 5 years. I think if you're starting from scratch and just have an ordinary job, it is reasonable to think that in 15 years you can retire. And to me, that's an amazing benefit. If you're starting earlier in your career and you want to retire in 15, 20 years, for most people, that's cutting their working life in half, which is a very compelling reason, at least to me, to get into real estate.
So you're sitting at your favorite ski resort and you decide, okay, you know what, it's time for lunch. I'm going to sit down at the table and grab a sandwich. And you hear some people talking about, investing in real estate, and they're saying, I can never do it. I don't have the capital. I don't know how to do it. What advice are you giving them to say, no, stop right there. You can do this. And here's how you do it.
There are many ways to get involved. And one of the things I love about real estate is that's so customizable to your individual circumstance. So if you're someone, let's just start with the beginning. If you're someone who just wants to get into the game, you can put as little as 3.5% down and buy 4 units, which is pretty incredible, right? There's basically, the way real estate financing works is anything that has 4 units, so a triplex or fourplex or fewer, is considered a quote unquote residential property. And that means you can get a residential loan on it. And so if you live in that property, you can get an FHA loan, which is a government program designed to help people afford homes. And you can put as little as 3.5% down. So if you're buying a duplex, let's say, that is $400,000, that means you can put a little bit over $12,000 down and own 2 units. You can live in one side, rent out the other, and maybe it cash flows positive for you. But at the very least, it's going to be greatly reducing your housing costs, which is as good or better than making more money because it's tax advantaged. So that is, I think, the easiest way for people to get in. And I don't think a lot of people know that you can buy multiple units for as little as 3.5% down.
How would one find that out, Dave? It seems so easy. You just rattled it off, but how do you find that out? Other than going to BiggerPockets and asking, how does somebody find out that, look, you know what, this isn't, the entry into this isn't that difficult?
Yeah, so BiggerPockets obviously has resources for it. I encourage people to also just talk to lenders and agents. I think there seems to be an aversion, or people are nervous about reaching out to a real estate agent or real estate lender. All of them will talk to you for free. So if you have questions about what you qualify for, what's possible in your neighborhood, then just reach out. And these are typically professionals who are incentivized in their own way to help you navigate the home buying process or the property buying process. And most of them can really help you. I do encourage, if you're going to be an investor, to look for a lender or an agent who knows how to work with investors, because there's a little bit of a different tilt there. But that's another great way to do it, is just have the free conversation and see what you can learn. So many people ask me all the time, they're like, do I qualify for this loan? I can't tell you, but a lender can. So you should go and speak with them.
So how do you avoid, you said something interesting, it could create positive cash flow. I would assume if you're going to get into a rental property and be a landlord, so to speak, you would want positive cash flow. I understand if you're living in one unit, renting out the other, there may not be positive cash flow because you're actually living in one of the units. But if you're going to try and make a living at this, or at least start the process of getting to a point where you could make a living at this, you would want positive cash flow. How do you evaluate that and make sure that happens?
Absolutely. And there's a sort of a debate in real estate investing on, do you need positive cash flow? Like, do you just do something for appreciation? I'm pretty adamant that you do want positive cash flow. It's not the most important thing to me. I am happy to get 3-4% cash on cash return, similar to a dividend or a bond yield, and then enjoy the upside potential of appreciation. But I totally agree with you that it puts you in a risky situation to not have cash flow. Real estate's your friend when you can hold on to it for a long time. And if you're coming out of pocket every month, you may be forced to sell before it's ideal, and that's something you want to avoid. The way to buy real estate investments in a safe, relatively low risk way is to just get good at running the numbers. And this might sound complicated, but it really isn't. Real estate investing, particularly when you're just buying a rental property, there aren't that many inputs, there aren't that many expenses. You're basically going to look at what your rent is, and then your primary expenses are going to be your debt service. So, presuming you take out a mortgage, but you're going to have mortgage, you're going to have insurance, you're going to have taxes, and you're going to have repair costs and maintenance set aside. So, that's, I think, a common place where new investors get tripped up is they don't set aside money to make sure that when things inevitably break, that you have money to cover them. I also recommend people keep a vacancy reserve. No one wants to have vacancy in their apartments, but it happens. And so you want to make sure that you have money to cover all of your expenses in those months. And if you do this, this is, this process called deal analysis. I call it underwriting. But if you underwrite your deals very conservatively, where you think, hey, things can go wrong, and you sort of plan for them to go wrong, and you do the analysis and the numbers still make sense, then you only really have upside, in my opinion, because you've planned for the worst, and the best can still, and something better typically happens. So that's what I recommend. And, BiggerPockets, we have calculators you can use to do this. There are other ones out there. If you're good at Excel, you can figure this out yourself. But it isn't really all that complicated.
Hanging on to the real estate, obviously, if you can avoid vacancy and continue to rent it out, or have people living in your properties, you hang on to them instead of flip them? Or is there a point where you say, you know what, the value in this area is going up so much that it pays for me to flip this, take the cash, and invest someplace else?
That's a great question. This is sort of where real estate becomes more of an art than a science, because there's not always a very specific way to do this. What I recommend to people is to really think about your long-term strategy, because flipping a house and being a rental property investor, they're pretty different businesses. They both fall under the category of being a real estate investor. But if you think about what the skill sets needed to be successful at one, it's kind of different, especially if you think about the time investment required to be good at one versus the other is pretty different. And so I recommend people start there. For me, as an example, I work full-time at BiggerPockets. I don't flip houses because it's too intense. I just don't want that in my life. I would rather buy a property, and I have a modest, pretty solid portfolio now, but I have a rule for myself where I don't spend more than 20 hours per month on my portfolio. And for me, I just keep buying rental properties because of that. Now, do I miss out on some possible appreciation and return because I take that approach? Absolutely. I have friends that are really good flippers, and they make way more money than me on a lot of deals, but they probably don't work full time, or they're spending 30 hours a week on this property, and that's still a very valid way to make money. And especially, I think, if you're early in your investing career and you want to build up some capital to buy rentals and retire over the long run, it can be great. But I think people really need to think about the lifestyle and skill set on top of just the returns. Because unlike the stock market, where it takes the same amount of time to own a dividend stock versus a growth stock, real estate investing, we call it investing, but realistically it's entrepreneurship. And you need to ask yourself what type of business you want to run. No wrong answers, but I recommend the self-reflection before you jump into it, because if you do something like a flip or a heavy renovation without knowing what you're getting yourself into, you can find yourself in a very time-consuming business, and potentially one that can get expensive.
What do you say to the person who says, you know what, I don't want to be a landlord, but I do want to invest in real estate?
There are many, many good passive options for being a real estate investor, and they sort of run the spectrum. There's sort of this spectrum in real estate between super active, which would be like self-managing a flip. You're there every day, you're doing all of it. On the other end of the spectrum are probably REITs. You can invest in publicly traded real estate companies, get some of the benefit of real estate, but that's probably not the most the highest return that you're going to get. There are two or three strategies for more passive folks that I recommend. The two or three of them I do. So one is just investing using a property manager. This does require that you do some work. So I still personally, I invest, I live in Europe. I still invest in the United States. So I work with a real estate agent to find properties. I do the deal analysis myself. That's something I'm good at. And so I do that myself. I create budgets and performas. And then once I buy something, I turn it over to a property manager that I know. We can connect you with property managers at BiggerPockets, but you should screen a couple of them and find one that's good for your business. And it does still take managing your property manager. You should know that it's not just like, hey, I bought this thing, you're in charge. They're technically, in a way, your employee, and you sort of need to meet with them. I talk to mine maybe an hour a month, so it's not a lot, but you need to pay attention. They'll send you reports, they'll send you financials, and you need to look at them and ask questions and be a diligent business owner. So that's one option that probably of all the passive options is the least risky, and I think a really stable way to build investment. The next one is something called turnkey investing. There's some companies that will find, rehab, and then manage properties for you. So they'll basically do the whole thing. That's a great way to invest. You just need to be diligent about vetting the company because you're putting a lot of faith, obviously, into the operator. There are many good, reputable ones, but I assume there are also some ones that might not do the best job with the renovation. So you want to be very careful there. And then the third one is one that I love. It's called syndications. And so this is basically when investors pool their money together and buy large assets. It's kind of similar. It's very similar to the private equity model, where high net worth individuals, and you do normally have to be accredited for this option. So that just call that out. If you're accredited, you can usually join together as a limited partner and select a GP, a general partner, who will buy usually a large commercial asset. So this might be a big multifamily, it could be retail, it could be office. And all of the work is up front there. You do some vetting of the operator, you look for the deal. Then once you fund that investment, it truly is passive. You don't do anything. You can review the financials, but it's entirely passive. I do this. I like it. Of course, the trade-off is liquidity. You don't get to choose when to sell. You don't have control over the asset. But if you can find good operators, this is a really good way to sort of leverage the experience and expertise of experienced investors and do very little in terms of time commitment.
So finding partners is a good idea. If you live in Europe, you invest in the United States. You said you work with a real estate broker. Are you invested in certain areas, or is it all over the country?
Great question. So I split my strategies a little bit. For anything that I own directly, so rental properties that I personally own in my own portfolio, I've kept it to two markets. So one in the Midwest, one in Denver. And I do this because there's limited upside into trying to maximize the exact right market. What I recommend to people is to find a couple of good markets that fit your strategy. So for the Midwest, tend to be great cash flow markets. Denver tends to be a great appreciation market. So I do one of each. And then within those markets, pick the best team, because there's cities that might grow faster than Denver, but if I have a great property manager, a great lender, a great contractor in Denver, that's going to have a bigger impact on my long-term returns than being in the number one fastest appreciating market in the country. And so I've found good teams in these two markets, and I feel that that's good enough diversification for my own direct ownership. When I invest in syndications, that's more of a free for all, because again, I prioritize in those types of deals the operator. And I happen to know and have found great operators, markets on the West Coast, in the South, in Texas, in the Northeast, all over the place. And when I find a good deal and a good operator, I'm comfortable investing in multiple places because I don't have to put together the entire team. As long as I like the general partner there and I trust them, I'm going to trust them to find, do all the marketing, to find the great property manager, to have all the contractors. And for me, I've been doing this for 15 years. And so I've come to a point where I have a well diversified portfolio. This is how I choose to diversify. If you're just getting started, for most people, it's best to just pick a market that you have a good team in and go in for a couple of years and really learn the business.
But it's best to have a team, not really go this on your own. Is that a good strategy?
As the capital partner, you can go on your own. I think it's really just about finding a team of support. And so you need an agent, right? Unless you're a real estate agent. That's super important. You need a lender. Most people don't buy cash. And you need a property manager if you're going to do it. And even if you self-manage, which a lot of people do, which I actually think is a great way to get started, is doing a lot of the property management yourself. You just learn the business really well and you save, 8 to 10% of your revenue. But like finding contractors, for example, is just something that you need to do in the business. It's not the most fun part of the business, but you need to find someone who's a good plumber, who's good an electrician. And that's what I mean by team. You don't necessarily need to employ them, but you need to have someone you can rely on when your tenant calls you and says the toilet's broken. Because I think that's the thing that people get. That's why people don't invest in real estate, right? They're like, I don't want to be called when the toilet's broken, and neither do I. But I have a good, plumber and a handyman who I can call, who will happily take my money to go handle that for me. And at first, you need to, it takes some time to build up that network of people. But once you do, the business really does become pretty autopilot.
Do you still own your first rental property or the first property you purchased?
No, I actually sold that in 2018, mostly because of partnerships. Like I said, I sort of joined with a bunch of people. There was no animosity, but after owning the property for 8 years, some people wanted liquidity. So we wound up selling it, and I used something called a 1031 exchange, which is one of the many tax advantages to being a real estate investor, and bought a couple different properties with the proceeds.
This show is sponsored by BetterHelp. In these crazy times we live in, it's probably the last thing on your mind, you and your self care. We all deal with it: work, kids, obligations, bills, you name it. Everything takes priority except you. If you've ever worked out or been an athlete, you've heard the saying, never skip leg day. But how about never skipping therapy day? That's right, I'm talking about taking care of you. Talking to someone who will help ease some of your burden so you can get back to what it is that makes you happy. I talk to a therapist, and it really helps to take the edge off everyday life. Maybe you're going through something and can't really pinpoint what it is that's bothering you. If you need to talk to a professional or thinking about giving therapy a try, give BetterHelp a try. It's easy, entirely online, convenient, and flexible to fit your schedule. Just fill out the questionnaire and get matched to a licensed therapist anytime. Never skip therapy day with BetterHelp. Visit betterhelp.com/wealthion today to get 10% off your first month. That's betterhelp.com/wealthion. Walk me through your first deal. It's almost like walking into a test that you're prepared for, but you're just not quite sure. Walk me through your first deal and what that was like. It's just because viewers are out there thinking, you know what, maybe this is a good idea, but I don't know. So walk me through your first deal and how that went.
What I did was first connect with a real estate agent and started looking at deals. I know this sounds backwards to people, but I really recommend starting this way. One, I actually think it's fun. I like looking at real estate, and I enjoy going to properties and checking them out. But two, to find funding and to figure out this business, you need to be able to identify good deals. That's really where the challenge comes. And so getting good at that is super important. And so I, at the time of my first deal, did not have a lot of capital, but I was able to identify a good deal, and I had learned how to do some financial modeling, the stuff we talked about, and was able to figure out that I had found a very good deal. that was probably better for potential partners than bonds, than the stock market, than other alternative investments. And I put it together, in a professional way, and went to friends and family that I knew and was able to raise money. It was four of us that went in and sort of split the down payment. I didn't even have enough money for my fourth of the down payment, so I took out a secondary loan from one of the other partners at a 7% interest rate, and then I self-managed the property to pay off that secondary loan. So I basically took the money as a property manager and reinvested that back into the deal. So it wasn't the most lucrative at first. It wound up being a grand slam over time. I made a great deal of money on that deal. But I was 23 at the time, and I was just very eager to better my financial position and was sort of willing to just hustle my way into it. And I did. I think the thing that people hear that story and they're like, well, I don't have money. And I'm like, well, if you go to a partner and say, hey, do you want to buy real estate? They'll say, yeah, maybe. What real estate, And so I recommend you start with the deal finding process, because that will make your conversations either with partners, your financial planner, your spouse, or yourself a whole lot easier when you're looking at something concrete and saying, hey, this deal will net me a 7% cash on cash return. It's probably going to get me an annualized ROI of 15% over the next 10 years. That's something you can look at and evaluate. If you're just thinking, hey, should I be a landlord? It's a little less tangible and harder to pull the trigger on, because you don't really know what you're getting yourself into.
So, being in Amsterdam, how do you find, or Europe, how do you find deals now? Do you just totally trust your real estate broker to say, hey, you know what, Dave, we found this for you. Let me know what you think.
I do a combination of things. So I have a real estate agent who sends me deals. Those are both on market and off market deals. Um, I also use a tool we have on BiggerPockets. It's called the Deal Finder. It basically allows you to simulate It's like, it looks like Zillow or Realtor, but it allows you to estimate your rental returns, cash on cash returns. And so I look at that, and I use that to screen deals. Then I analyze them. So I use a calculator and say, hey, here's the expected rent. Here are all my expenses. How does this stack up to, alternative investments? This is how people invest, right? Like, you look at one option versus the other. So I look at different real estate investments. I invest in equities as well. I weigh this against putting more money into the stock market. And once I've decided that I like them, then my final step is actually having my property manager go walk the property for me. I do trust my real estate agent, but their specialty is identifying deals, negotiating. Property managers specialize in what tenants like and what they're going to ask questions about, what there's going to be demand for. And so before I put something under contract, or before I make an offer, I always have my property manager go over there and say, you know what, this is a great deal. Or just the other day, I was looking at a deal that was supposed to be a 2-bed, 1-bath, and he said, this is a great deal, but it says it's 2-bedroom, but there's actually no dividing door, or you have to walk through this bedroom to get to the second bedroom. People aren't going to like that. So it's going to actually get rented like a 1-bedroom, even though there's 2. So like, that kind of advice is invaluable. And I also go to these markets at least once or twice a year. Sometimes it's after I've bought things, but I do think it's really important to go lay eyes on them. You don't have to do it all the time, but I think, one, just maintaining those personal relationships with your property manager, with the other people. So getting a sense for your property manager, getting a sense for the neighborhood is always important. How things change over time. So I still think it's important to physically be there, even if it's just once a year.
Are there certain areas that are better for rentals than other areas that are residential, but people really are not renting in that area?
That's one of the things I recommend people look for when they're picking a market, is the home ownership rate, because it's true. There are some areas, like particularly the suburbs or rural areas, where the home ownership rate is super high. It could be like 70, 80, 90%. And so it doesn't necessarily mean you can't rent, but your pool of renters and your demand is going to be less. I personally like markets where there's a high percentage of renters because you're always going to be able to find a tenant, like college towns or areas where young professionals live. Those tend to be really good areas. I like those. I also like areas with families as well, just in more urban areas where there's more uh, renter pool, but I doesn't necessarily have to be young professionals. Families still make great tenants as well.
So talk to me about the interest rate now. And I know that there's lending involved. Not everybody walks in with a pile of cash and buys everything for cash. The interest rates right now are on the higher end. I mean, I of my first mortgage, I paid a lot more than 7%, but they're on the higher end. How does that figure into, purchasing at this point?
Higher interest rates have definitely made it harder to find cash flow. I don't think it's changed the fundamentals of long term real estate investing, but it is much more difficult today to just look on Zillow or BiggerPockets and find a deal right off the bat where you're going to generate positive cash flow. It's still definitely possible, but it depends on the market. Higher priced markets in particular have it's become difficult. So in those markets, the strategies that work best are typically what's known as a value add strategy, where you buy something that is not up to its current highest and best use, but you make it, you renovate it. And that can vary from a gut rehab to painting and putting down floors. I like to do the lower end, the lower lift kind of value add, but it can still be generate great cash flow. But if you look at markets in the Midwest or actually a couple markets in the Northeast, you can still buy cash flow right now. And I think the truth is that if you can find deals that are good right now and give you the right return right now, they'll only get better when interest rates drop. I'm personally not one of those people who thinks we're going to get back into the 4% interest mortgage rates anytime soon, but they'll probably come down in the next few years to the mid fives. That will save you a couple $100 a month on your mortgage if you refinance them. And that will only improve your returns over time. That said, I never recommend people buy deals that only will work with a refinance. That's really risky in my mind because we obviously don't know where mortgage rates are going to go. We can guess, but I would only buy a deal that pencils out today with high interest rates. And it's sort of one of these things where it's like, trial by fire. If you can find a deal during a difficult time, then it's going to be very, very good deal over the long run. But it definitely makes the identification of a deal process harder.
Do you take the proceeds from the rent and put it into the mortgage, or some of them? Obviously, some you're looking for some income, but do you try and shorten the length of your mortgage and increase the cash flow over time? Because once you get rid of that mortgage, it's all, other than taxes and maintenance and that stuff, it's all free cash flow.
That's a big debate. I personally don't at this point in my real estate investing career. I really love fixed rate debt, and I like to lock it in because it's one of the benefits of real estate, and it's very unique to the United States where you can get a mortgage and lock in debt for a long term. Because even though that payment stays the same, like rent goes up. We've seen that a lot over the last couple of years, and that's why real estate investing is such a great inflation hedge because rents keep up with inflation at the very least, if not exceed inflation. Meanwhile, your debt payment stays the same. And so I personally am content with that. I think as I get older and approach what I would consider a retirement, maybe 10, 15 years from now, I'm in my mid 30s, then I would do exactly what you're saying. I would deleverage as I approach my real estate investing career, either by making additional mortgage payments, like you said, or when I buy a property, instead of taking out the max leverage and using an 80% mortgage, I'd maybe put 50% down or 40% down. That does hurt your long-term return potentials. Leverage is one of the great benefits of real estate investing, but it reduces your risk. And if you are one of those people who's actively trying to replace your income, that can be really beneficial. But again, I work full time, so I'm not trying. My goal isn't to like fully replace my income, and I'd prefer to enjoy the benefits of leverage and appreciation right now.
Last question, Dave. What are some of the pitfalls that's if someone wanted to get into this and you got into it with some other people, and so that I guess you manage that risk a little bit. But what are some of the pitfalls someone has to look out for, either purchasing their first property or saying, "Oh, I want to get into this, but I don't know what I'm doing."
I think the biggest risk in real estate investing is overly optimistic assumptions when you analyze a deal. As I was saying, it's pretty easy to analyze a deal. You figure out what the rent is, what the expenses are. A lot of people get really excited and see, oh, during the pandemic, rents went up 10% a year. That was very anomalous. It's probably never going to happen again. It may, but who knows? I wouldn't count on it. So, what I advise people to do is rely on historical growth rates. So, that deal analysis is probably the main pitfall. The second one is people biting off more than they can chew. I think it's really tempting to look at a fixer upper and say, oh, it's so cheap. Real estate, like most markets, are pretty efficient, and so if there is a deal that's cheap, there's a reason for it. And it probably means that there's a complicated and potentially expensive renovation in store. If you're experienced at real estate, fantastic way to make money. But I recommend for people, just try and hit a single right away. Like, you don't need to make a ton of money. I would recommend, just getting an average rental property is usually going to get you 10, 12, 14% annualized return. So it's still better than the traditional, the average of equities. Of course, you're working for that. So you have to decide if that, time commitment is worth it to you. But to me, getting that 12%, 13% return on your first deal is a learning experience. You're an entrepreneur. You got to learn your business. Then you can take bigger swings in the long run. But at first, just buy something simple, learn the business, and start building your network of other investors, of contractors who you can rely on. Once you have that in place, that's when you can start taking the bigger swings.
Do you ever run into a situation where, or I guess, someone's getting involved in real estate investing, they find a great property, good property, now they want to buy another one, but they have a mortgage out on that first one, and their regular job doesn't qualify them to get another mortgage. So how do you combat, like, okay, you know what? The bank says I'm over leveraged, or I'm leveraged to the point where I can't get another mortgage?
There are two great strategies. One is just partner. Sometimes you can find another investor who wants to partner on a deal and might have a better or a healthier debt to income ratio where they can qualify. The second is that there are more different types of loan products that won't look at your personal credit. So this is similar to how commercial real estate is financed, where instead of looking at your individual credit worthiness, you look at the quality of the deal. That's how, if you were to buy a retail property or an office property, the bank would look at you. They're called debt service coverage ratio loans, or DSCR loans. And they'll basically look at your underwriting and say, okay, Dave, this is a good deal. Like, you've found a property that will cash flow. And we, because of that, feel confident that you're going to be able to pay your debt service. And if you can't, we're going to be able to take over a cash flowing asset from you. And these do tend to be a little bit more expensive in terms of interest rates than a conventional loan. But as an investor, this is a business, and eventually you're going to have to get away from conventional financing and owner occupied financing. It's just inevitable. So it is a good option. I would just advise people to look at the terms. Sometimes there are balloon payments or prepayment penalties. That, the loans can get a little more complicated. There's nothing wrong with that, but make sure you fully understand the terms of those loans before you sign anything.
Would you set up a separate corporate? I know I said in my last question, but I keep asking questions. But would you set up an LLC or a separate corporation to keep all your real estate in one place, as opposed to having it all in your name?
This is a big debate in real estate, but you find the BiggerPockets forums full of this question. I'll just tell you what I do. I put every property in a different LLC. I don't know if I'm just paranoid. I like to keep each property in its own LLC. So if anyone, there's just limits liability. The maximum you could lose on any one lawsuit would be what's contained in that one LLC. I also just think for reporting purposes, it's helpful because, I have some deals with one partner, other deals with another partner, and I just keep it all separate. It does create a lot of different bank accounts. So that gets complicated. But usually when you reach a scale where that gets complicated, you're able to find, hire a bookkeeper and a CPA to help you manage that. That's what I do.
Dave, thanks so much for joining me. Other than Bigger Pockets, where else can we find you? I know the BiggerPockets.com, Bigger Pockets podcast. Can we find you on social media where we can get tips and things that you're up to?
Sure. Yeah. I am pretty active on Instagram, where you can find me at the Data Deli. I am a sandwich enthusiast, being from New York. And you can find, I frequently talk there just about real estate tactics, but also a lot about economics and how macroeconomics change the housing market.
Awesome. And where do we find, if we wanted advice or become part of the Bigger Pockets community, how do we do that?
Just go to BiggerPockets.com. You can join the community for free. As I said, we have over 3 million active and aspiring investors there. It's a super helpful community. There are very active forums, people just trying to help each other build long-term wealth through real estate.
Are there people there looking for partners?
Oh yeah, all the time. Yeah, there's tons of people looking for partnerships. That happens all the time. We do a lot of live events. Great place to network. And so recommend you check out BiggerPockets.com. We have pretty much everything people need to get started.
Awesome. Dave, thanks so much for joining me. I really appreciate it. And if anybody is looking for a way to get into real estate, Bigger Pockets will get you on the right road to helping you figure that out.
Thank you so much for having me. I appreciate it.
That's a wrap on another discussion here on Wealthion. Thank you for joining us. If you need help being financially resilient, please head over to our wealthion.com. Sign up for a free, no obligation portfolio review with one of our registered investment advisors. And remember to follow us on social media for the latest news and information to help you invest wisely. And if you could like and subscribe to the channel, we'd greatly appreciate it. Don't forget to hit the notification bell so you can find out when we post new videos to the channel. Thanks again for watching. Until next time, stay informed, be empowered, and may your investments flourish. And if you like this content, please watch this video next.